Good day, traders. This is Roger Scott from Market Geeks, and I hope you had a great weekend. I have another trading tutorial for you today. Before I begin, I'd like to remind you to subscribe to our video channel, and don't forget to visit marketgeeks.com for your free trading report. There are hundreds of different day trading indicators traders use to help them gauge short-term market action. One of the most important and often misunderstood indicators is the New York Stock Exchange Advanced Decline Line. The ADL, as it's commonly called, is a different type of indicator. It's called an internal market indicator or market breadth indicator because it measures the cumulative sum of the daily difference between the number of issues or stocks advancing and the number of stocks declining in the New York Stock Exchange. In simple terms, it moves up when the index contains more advancing than declining stocks and moves down when there are more declining than advancing stocks. The ADL measures market strength and weakness differently than the S&P 500 index, the NASDAQ, or the New York Stock Exchange index because these instruments are capitalized weighted, which means they allocate more weight to very large companies and less weight to smaller companies that make up the index. The ADL line is cumulatively weighted, which allocates weight equally to all stocks that make up the index. One of the most reliable methods professional traders utilize the advanced decline line is by watching for divergence between the stock market and the advanced decline line. Oftentimes, you will notice that the stock index is rallying upwards while the advanced decline line is beginning to come down. This is a sign of divergence between the two instruments and oftentimes signals that the stock market is running out of steam. I find that divergence analysis works especially well for short-term price swings or as a confirmation indicator when I'm day trading. In this example, the New York Stock Exchange makes two higher peaks during the second week of February of this year. The second high is not substantially higher than the first one, but it's still higher. When you see patterns similar to this one, you should compare it to the advanced decline line to see if the momentum is continuing or declining across the entire exchange. This will give you a clearer picture of the stock market as a whole instead of a handful of large cap stocks that dictate the majority of the trading action on the New York Stock Exchange. Notice how the advanced decline line is moving down during the same period of time. This demonstrates to me that the stock market is running out of steam and setting up for a sell-off. I go through this type of exercise each day after the close to see if momentum is across the entire stock market or just a handful of stocks. Eventually, the New York Stock Exchange index catches up to the ADL and begins moving in the same direction. Remember, the ADL or advanced decline line uses every stock in the index equally, and the New York Stock Exchange is a capitalized weighted index, so large cap stocks that have a lot of institutional buying move before other small stocks gets a chance to follow. This creates a lagging response between the large stocks and the smaller stocks. This is what you want to exploit by doing divergence analysis. You can see in this example how the New York Stock Exchange turns down and follows the advanced decline line right after the divergence occurs. You can see how the New York Stock Exchange is making higher highs in mid-January of this year. I typically measure divergence between the two instruments between 3 and 5 days apart. This way I can see if the New York Stock Exchange and the ADL are catching up to each other or are moving further away. With time, you will get a good feel for spotting divergence between these two instruments. The advanced decline line is moving sharply down during the same period of time as the New York Stock Exchange is making higher highs. You can see how the broad market is beginning to turn down while the large cap stocks driving the New York Stock Exchange are still being accumulated. It only takes a few days for the New York Stock Exchange to catch up to the ADL, so make sure you monitor divergence carefully between the two for short-term trading opportunities and confirmation signals for other patterns or indicators. You can see in this example how the New York Stock Exchange sells off and begins moving in a downtrend along with the advanced decline line. It doesn't take a long time for the large caps to realize that smaller stocks are losing momentum and begin moving in the same direction. Therefore, you must take advantage of these opportunities as soon as you see them. When using the advanced decline line in your analysis, always remember to compare it to the New York Stock Exchange. While there are other advanced decline lines for indexes such as NASDAQ Exchange, I highly recommend you stick with the New York Stock Exchange and the advanced decline line based on that exchange for the most accurate divergence analysis. Always remember that the index is driven by a few very large cap stocks, and the advanced decline line is driven by all stocks regardless of their size or institutional sponsorship. The large cap stocks usually lead the index, but eventually they catch up to the rest of the stock market. You need to understand this concept because the concept of divergence is based on this idea. Next time, I will demonstrate additional indicators that will help you gauge market strength and weakness with precision. Thanks for joining us for today's tutorial. Don't forget to subscribe to our channel and visit MarketGeeks.com to download your free trading report. Till next time, have a great trading day.